In today's video, we're going to talk about what I do with my Amazon book profits. I sell books on Amazon, I make money from that, and unlike a lot of people, I don't just take every dollar that I make and reinvest it back into the business, at least not anymore. I used to do that in the beginning, 7, 8 years ago when I didn't have very much money to my name. But over time, as I've made more and more money through both my teaching job as a high school chemistry teacher and then also selling books on Amazon, I've decided that it actually is better for me to actually control my assets. In other words, I don't really want my entire net worth tied up at Amazon because right now there's, so many Section 3s going around and, there's always, like, even though I'm doing Amazon to Amazon book flips and I do have an invoice from Amazon and Amazon order ID, and that has been shown and proven to work time and time again, at the end of the day, I think Amazon, you should think of Amazon as just like an amazing income generator, but not like a wealth generator. So you don't want to put all of your eggs in just one basket into Amazon. Don't want to put all of your money in just to one place. And so you really want to diversify. And so this is going to be a longer form video about what I do with those profits. And hopefully this is helpful to you all. Let me know down below in the comment section if you want more videos like this. But let's continue. So, last year in 2025, I sold a little bit over $300,000 in revenue, made right around $100,000 in profit. And again, I'm not going to take all of that money and reinvest it back into my business because I've gotten to the point where, my cost of goods sold account is just continuously getting replenished. I do, every paycheck essentially, put an additional or allocate an additional 5% of the profit that I make back into, buying more books. So I am slowly growing, but I'm at a point where I'm sustaining myself, right? Where I'm always able to buy around the same number of books every year and sell very similar numbers. In 2023, I did just under 300,000. So very, very similar numbers year over year. But the money that I actually make, I invest into the S&P, well, not the S&P 500, actually the total US stock market. And I do that through a brokerage called Vanguard. And what you need to know is I'm not here pitching Vanguard to you like I'm affiliated with them. I make absolutely $0. If you sign up with Vanguard, you can choose any other brokerage. I'm just simply showing you what I do. And so if you want to follow what I do, then simply just do that. But it doesn't have to be Vanguard. It could be Fidelity. It could be Charles Schwab. It could be any other brokerage. And if you're like, what the heck is a brokerage, Joji? A brokerage is simply just a trading platform. It's where you can go buy and sell stocks. When I did my Finance Friday videos for my students in high school, the way that I would explain a brokerage to them is it's like a grocery store. It doesn't really matter which grocery store you go to. You can go to Trader Joe's, you can go to Stater Brothers, you can go to Ralph's, you can go to Aldi. It doesn't really matter where you go. You're generally going to find the same products. You're going to find milk, you're going to find eggs, you're going to find bread. Just like at Vanguard or Fidelity or Schwab, you're going to find very similar funds. Now, like stores, they're going to have slightly different fees. Just like if you when you want to buy milk at Walmart or Target or any other store, there's slightly going to be variations. And so, yeah, that's just the name of the game. That's just what you expect when you go into different stores. And, you might ask, why do I prefer Vanguard? I prefer Vanguard because they have the lowest fees. At the end of the day, research shows that when you're investing in something, the lower their fees, the better, because compounded annually over a long period of time, a very small difference in fees can make a massive difference in like the portfolio value of your account. So it makes sense to go with the lower fees. That's why I choose Vanguard. But again, if you choose another brokerage, it really at the end of the day doesn't matter too much as long as you're finding a fund or you're investing in something that has a low expense ratio, which simply just means like what they're charging you to actually invest in it. And going back to the analogy of a grocery store, it's kind of like, why do you like going to Trader Joe's versus going to Stater Brothers? Well, I don't know. I just like the atmosphere better. I like the people better. I like the products are slightly cheaper. This is very similar though, right? It's like you have a preference over one thing. I have a preference for Vanguard. So that's who I do my investing through. And so when I'm talking about what do I do with all this extra money that I make, I invest not in Vanguard, I just invest through Vanguard. In other words, I use Vanguard as the brokerage to do my investing with. Hopefully that makes sense. And if not, I can break it down a little bit more. You just have to let me know down below in the comment section. All right. So Vanguard is a brokerage with which we can invest into different things, different products. And so a lot of people, probably, I don't know, you may or may not have an investment account, and all you need to do is go to Vanguard.com. And if you're interested in opening up an investment account, you would just, come here to personal investors and you would come up to this button called open an account. And once you're there, you're gonna, I already have a login, so I would just log in here. But if you don't actually have a new account, you'd have to click this open an investment account. You just click getting started, and you'd set up your new account. So you'd have to essentially tell them what it is that you're doing. And these might apply in different scenarios. But in this case, if you don't have any investment accounts, then you would just say, hey, I'm going to open a new account with money from my bank. Now you could, for example, have a 401k if you are working at you have a 9-to-5 job. And if you ever leave that job, you could take that 401k and roll it into a Vanguard through an IRA. But in this case, we're just going to say, hey, you're somebody who's selling books on Amazon, you're somebody who's making money, and you want to go ahead and actually start investing. Well, you'd simply say, open a new account with money from my bank. They have an awesome 3-minute video that shows you exactly everything that you need and how to do that. And it's actually pretty it is actually pretty easy. So let's see, already a Vanguard client. I am, so I'd click that, but here you just say get started. And then what you need to do is select the specific account with which we're going to invest in. You can see that this process takes about 5 to 10 minutes. So in as little as 5 to 10 minutes, you could have your account set up and really be ready to go, set up automatic investments so that every week or every couple weeks you have a certain amount of money that goes towards these investments. So you just say select your account there, and you're going to choose the account that's makes sense for you. And you can see there's a bunch of accounts, so it's super overwhelming. In this case, we're talking about actually investing in the total US stock market, right? So I'm somebody who follows something in this book that's very simple. It's called The Simple Path to Wealth. It's written by J.L. Collins. I would recommend you pick this book up, especially if you're somebody who does Amazon to Amazon book flips. You should know, or maybe you may or may not know, but let me see if I can get this to refocus again. If you're somebody who does Amazon to Amazon book flips, you do get credits for the money that you spend on books for Kindle points, Kindle rewards. I think you just literally type in Kindle rewards, I think it is, into Google. And when you do that, you click on Kindle rewards beta, and you can see I can redeem some points here. So it's time to redeem your $3 reward. So you get 3 points per dollar spent. Not that $3. 3 points per dollar spent on Kindle books, which is not what we're doing. We buy books, but you get 1 point per dollar spent on print books. Essentially, you just come to the site and you can redeem a bunch of points for Kindle, and then you could go buy this book, The Simple Path to Wealth, for free, essentially. Because if you're buying books right now, then you are able to accumulate these Kindle rewards points, go buy the book, and get the Kindle, version for free. So that's what I'm talking about. Okay. So certainly they have different accounts that are for like savings account that says APY, annual percentage yield. So you'd get like 3.65%, but we're not talking about a savings account. We're talking about an investment account right now. So what I would recommend is that most people open a Roth IRA and not a traditional IRA, because most people don't make a ton of money, and it makes more sense to have a Roth IRA, because Roth simply means the money that's going into that account has already been taxed. In other words, the tax benefit you're receiving for opening this account is actually later in retirement, later on in life, where once you turn 59 and a half and you start withdrawing money, if you want to withdraw money at that point in time, you don't actually pay taxes on the earnings in that account. Now, if you go with a traditional IRA, you simply get tax benefits in the beginning, which just means that when you look at your total income at the end of the year, if you invest money into a traditional IRA, you could deduct up to the maximum amount, which I think, the max IRA contribution in 2025, I think, is going to be $7,000 if you're under 50 and $8,000 if you're over 50. So let's just say hypothetically you made $50,000 in 2024. Actually, let's look at the 2024 contribution limits. So let's say you made, it's still the same, $7,000. Let's say in 2024 you made $50,000 after all fees and all deductions and all that stuff. Well, if you invested the max of $7,000 in a traditional IRA, well, now your adjusted gross income is not $50,000. it's actually 50,000 minus 7,000, which is 43,000. So you wouldn't pay taxes on that money, but you would defer it later on. So when you retire later on and you start withdrawing that money, you would actually be paying taxes on the investment gains on that. Well, actually on everything, because even your contributions at that point in time in the beginning were not taxed either. So you'd be paying taxes on everything at that point. So I recommend going with a Roth IRA because the way that our tax system works is that you obviously pay more in taxes the more money you make. So if you're somebody who's not really making a lot of money, and I'd say not making a lot of money is like, under a couple $100,000 a year. Like if you're not making that much money, then going with the Roth IRA, I think makes more sense because you'd be in a lower tax bracket anyways. And so it makes sense for you to pay taxes now when, taxes are actually pretty low and you're in those lower tax brackets, so that later on in life, when you are starting to withdraw money, it's tax free, and that's awesome. So I think the Roth IRA is the best account for most people. And again, I'm not a financial advisor. None of this is financial advice. This is just some random guy and things that I do. So yeah, I guess I should say that don't follow anything that I'm saying. I'm not a financial advisor. I'm just telling you what I do. So, all right. Now what you do is just tell Vanguard about you so they know who you are. It's as simple as putting in your first and last name, putting in your email, your birthday, your citizenship, your social security number, and then you just continue on from there. Now, I've already done this, so I guess I can't really go too much further than this, but all the other things that you'd really need to go on from here are really quite simple. You're going to need to have a bank account. So you need to have a checking or an account number and a routing number. So when you do make investments, you can take those investments and essentially, send them to Vanguard, the settlement fund, which you can then take that money and invest in their products, if that makes sense. So I kind of got you as far as I could without, me just putting in fake information, which I don't want to do. But that's the process. There's not too much to it. It's just kind of a verification of things about you. It's pretty self-explanatory that you can walk through it. Now, once you've got your account set up, the next question everyone has is, well, what do you invest in, Joji? And I'll go and share you what I invest in. And it's actually incredibly simple. And it's this one index fund called Vanguard Total Stock Market Index Fund, abbreviated with the ticker symbol VTSAX. A ticker symbol is just an abbreviation of the fund. And in this case, an index fund is tracking a particular sector of the market. In this case, it's the total stock market. So to make this as simple as possible, I take the profits that I make and I invest it in essentially the U.S. economy. And the reason why I say the U.S. economy is because this index fund is a basket of every publicly traded company in the United States, which right now I think is like over 3,000 companies. So what we could do is kind of just take a peek at the fund a little bit more to see exactly what the portfolio composition is. But again, notice that the expense ratio, this is the fee that they're charging you to invest in this account, is very, very low. It's 0.04%. So in other words, 0.0004. Very, very low, and that's good. If you're in other mutual funds, or a mutual fund is essentially, it's similar to an index fund, but a mutual fund is when you have, investing professionals who manage your money, select different stocks and different companies, and they try to essentially beat the S&P 500 index. And again, an index just tracks a particular sector of the market. And so when we say S&P 500, we mean the top 500 companies. So anyone who's stock picking or trying to pick, Apple stock and this penny stock, all they're trying to do is beat the S&P 500, which is the benchmark with which we measure everything. It's like the measuring stick. Every year the S&P 500 returns this percentage, and everyone who's actively trading and trying to buy all these companies, they're just trying to beat that average. So the point that I guess I was trying to make here is that when you are in a mutual fund where you have somebody picking your investments for you, often the expense ratio is like 1%, which is way higher than 0.04%. And that might not seem like a big difference, but over a long period of time, 15, 20, 30, 40, it could be hundreds of thousands of dollars more that you're paying someone to actively select stocks for you through the mutual funds that they make, when you could have just invested in the S&P 500 or VTSAX like this for a very, very low fee, and more than likely outperform that mutual fund anyways, because of the fact that it is incredibly difficult over a long period of time to just beat the market average, which is what the S&P 500 returns or VTSAX returns on an annual basis. So what you'll learn in this book, The Simple Path to Wealth, is that investing is actually very simple, and the more complicated you make it, the more likely it is that you'll do worse or have worse performance. And the simpler you make it, the more likely it is that you'll actually do well. So I take all the money that I make, I should say almost all the money I make, a large majority of the money that I make, and I just put it into VTSAX, because when I put my money into every single publicly traded company, essentially what I'm betting on is that the US economy over a long period of time, I think, is going to perform well and is going to prosper. And therefore, when I decide to sell these shares later on, when I need that money, I believe that the value of those shares will be worth more than what I'm paying for them actively today. Now, one thing you need to know is that this has a minimum investment of $3,000 for this particular fund, for this index fund, but there's also the ETF version, the exchange traded fund version, starting as low as $1. And so before you get to $3,000, you'd actually just invest in the Vanguard Total Stock Market ETF. It's essentially the same exact thing, and this ticker symbol is VTI. So VTSAX, VTI, you're investing in the same thing. One's an index fund, one's an ETF. There's slight differences, but again, don't make it overly complicated. You'll invest in VTI if you're investing less than $3,000, and then as soon as it becomes more than $3,000, it's actually just going to convert over to VTSAX, the Admiral Shares version. So again, I'm trying to not make it too complicated, because if I make it more complicated, then people shut down and they stop listening. So this is great. 0.04% expense ratio. You want that to be incredibly low. All right. Now, what we'll look at is the portfolio composition, which is going to show us the number of stocks in this index fund. When you invest $1 into VTSAX or VTI, the same thing, you're essentially taking that dollar and dividing it up into 3,615 companies. So you're being incredibly diversified, because you're saying, instead of taking my money and investing it all in Apple stock or investing it all in Bitcoin or investing it all in Tesla, I'm just going to invest a little bit of it into everything. And the reason why you would do that is because if you believe long-term that the US economy as an overall average or as in general is going to perform well, even despite the fact that there will be losers, meaning there'll be companies that go to zero and companies that go bankrupt, if you fundamentally believe that long-term the US economy is going to prosper and that the majority of companies that are currently on the stock exchange are going to do well and perform, then by owning this thing, you've essentially decided that, hey, yeah, I don't really care which companies do well or which companies do bad. I think the majority of them are going to do well. And so if I own all of them, it doesn't matter that company X, Y, and Z fail, and then company A, B, C, D through X or whatever, I don't know, all these other companies succeed. So the reason why I do it is for diversification, and I believe that the entire U.S. economy as a whole is going to prosper into the future. And I understand and realize that it's actually incredibly difficult for you to hand select which companies are going to do well, because just the way that, life changes. Like in the last, just even in my lifetime, in 30 years, there's been so many changes, so many new companies that have come up that no one could have imagined or foreseen. And I expect the next 30 years is going to be very similar. So I'm essentially saying I'm not smart enough to know which companies are going to be here 20 years from now and which companies are not. I know that when it comes to picking stocks, I might have better odds closing my eyes and putting all of those different companies on the board and just throwing darts at them and selecting those ones. Like, that might be a better strategy than trying to hand select them. So why even try? There's going to be so much there's so much research that would have to go into figuring out which companies you think are going to do well. You'd have to open up earnings reports. You'd have to be tracking, what the CEOs are saying. Like, there's so much that would go into you trying to figure out which companies are going to do well and which companies are not going to do well. And it's just incredibly difficult and statistically improbable over a long period of time. So why even bother? So my goal here is just to invest in essentially every company, understand that some of them are going to lose, the majority of them are going to win. And if the majority of them win, just like with book flipping, if 80% of the books you buy are successful and succeed, then you're good. Even if 20% lose, it's all good. So that's what we have there. You can see there's all these other things here that are just noise that don't really mean anything. Of course, they have they have significance, but again, the goal is the simple path to wealth. Like if you want the simplest path to wealth, it's essentially make money, earn an income, live on less than you make, invest the rest into something that is as much of a guarantee as you can get, right? There's nothing that's 100% guaranteed in life, but I would say investing in the entire US economy is probably as close as you can get to having a guaranteed prosperous future. So let's see if there's anything else here. Yeah, you can see what VTSAX is broken down into as percentages. So one thing that you have to understand is that this is a weighted fund. And what that means is that even though we're investing our money into 3,615 companies, we're not investing every dollar into each of them equally because it's because it is a weighted average. In other words, most of your money is going to go to the companies that hold the most asset value. In other words, the largest companies in the United States. And you can see the breakdown here by sector is that you can see the largest sector in VTSX is technology. And that's because if you think of the biggest companies in the United States, the biggest companies in the United States are technology companies like Apple and Google and Microsoft and so on, right? Versus only 2.5% is real estate or 1.9% is telecommunications. So the point I'm trying to make here is that it's not like every dollar you invest is equally split among 3,600 companies. It's actually weighted based upon the companies that are worth the most, if that makes sense. So yes, when you invest in VTSAX, whichever company right now is valued the most, which happens to be Apple, most of your money is actually going to go into Apple. So like, if you invested $1, it's not like, 3,615th is going to go into Apple. It's the majority of your money is going to go into Apple. So maybe out of that $1 that you invest, maybe 1 penny of it goes to Apple. And then maybe, 87 cents goes to Microsoft and 65 cents goes to Nvidia. And I'm just making this up. And 45 cents goes to Amazon. And then you go all the way to the bottom. You go to page, I don't know, what page is this? You go to page 358, and at page 358, you would have FTE Networks, which is barely on the stock exchange. You might have, 0.0001 cent into that because of the weighted average. So it is going to, be weighted based upon the most valuable companies, which, no surprise, these companies up here are incredibly profitable. And yeah, the cool thing about investing in VTSX is you own everything. And that's what happens is when you invest in a company, you own that company. You're a partial owner of that company, which is awesome. And yeah, again, this is cool. You're investing in Amazon. So it's another way to invest in Amazon, but you're now investing in Amazon, the company. And this you actually do own outright with 100% control no matter what. It's not like having an Amazon account where if you get shut down, that's it, and your assets could be seized or whatever. It's like, no, you actually are investing your hard-earned money into this fund, and you own the fund, and you have the ability to decide when you want to sell and when you want to buy. So hopefully that makes sense. Let's see. What's cool is that they also have a distribution schedule quarterly, which means that you get a dividend payout every quarter or every 3 months. So what the heck is a dividend, Joji? Well, a dividend is essentially profit that's given to the shareholders of the company. When you invest in VTSAX, you become a partial owner of every company. And what that means is every company is going to pay you profit or a dividend because you own the company. And again, you own a 0.0000000000000 some percent of Apple, but you still own that percentage of Apple. So you get a dividend, you get a check, a profit check at the end of every quarter. So all this is showing here is how much you would make per share and the payable date. So the most recent dividend was processed on December 24th of last year. And it looks like you were given 45 cents for every share that you own. Whoa, 45 cents for every share that I own? How much is that? Well, how much is a share of VTSAX right now? VTSAX. A share of VTSAX right now is $144. So for every share you wanted to buy today, you'd have to spend $144. And for every share you owned, you would have received a dividend of 45 cents. So this is another reason why investing is cool, because you are making profit by essentially owning these companies. And so I think at the end of every quarter, I get a dividend of, I don't know, $400 or $500. I don't know what it is, because I own, my wife and I collectively own a few thousand shares. I don't know how many thousand, so some number of thousands of shares we own. And so one share is worth $144 currently, which again, the value of the shares, the value of the ownership is essentially, it changes over time. So think of a share as essentially a ticket of ownership to all these companies. So if you want one share of VTSAX, you have to pay $144 because you'll get that from somebody else who's essentially selling it. Okay, let's see if there's anything else here. The cool thing about this, and the reason why the expense ratio is so low, it's only 0.04%, is because there's not really any managing or any trading that needs to be done. It's pretty simple. The instructions of this fund is buy everything. Buy and hold everything. It's not like you need to buy this and sell that and buy this and sell that, right? And so there's no reason for the fees to be high. It's pretty simple. Just buy everything. And that's what we do with VTSAX if you are investing over 3,000. And that's what we do in ETF, VTI, the ETF version of VTSAX if you're starting with under 3,000. And again, you can start investing with literally as little as $1. So there's really no reason to not start. I mean, at least invest $1 just to see what happens, if that makes sense. Okay. Now, like I mentioned, I like Vanguard because they have the lowest fees. There are also other brokerages that you could use, like you could use Fidelity and Fidelity. I forget exactly what we'll just say total market index fund. So they have the same thing. They offer the same product, a total market index fund. It's essentially like, Vanguard offers eggs, Fidelity offers eggs. They might offer it at a slightly different price for you to invest in, but they also offer it. So Fidelity Total Market Index Fund. The ticker symbol is FSKAX, and it's priced at 164. So you might be asking, why is it different than Vanguard Total Stock Market Index Fund is? Well, I don't know. That's a good question. I actually don't know the reason as to why that is, but essentially the returns are going to be identical because of the fact that you are investing in the same exact thing. So you can see that the charts look pretty much identical here. One is just over, looks like the Fidelity Total Market Index Fund has only been around since 2011. That's the inception, versus VTSAX inception is 2000. So that's why the graph looks a little bit different, but essentially the same thing that you're investing in. And what is the expense ratio? The expense ratio is actually much lower with Fidelity. It's actually, when I say much lower, I mean 0.04 is already incredibly low, but 0.015 is even lower, which is cool. So if you want to go with Fidelity, that's great. Do that. The only reason why I go with Vanguard is because the founder of Vanguard, his name is slipping my mind right now. But essentially Vanguard is owned by their investors, which is unlike any other brokerage. And so I just personally really like Vanguard. So yeah, I'm paying slightly higher expense ratio, but I just like Vanguard. And so therefore I go with Vanguard. But my point is, you could use a different brokerage. You could also use, like Charles Schwab, or you could use TD Ameritrade. Like, it doesn't really matter what you use. What matters is, did you do the investing and did you invest in the right thing? All right. So going back to, well, what sort of profit am I investing into this? Well, back in 2017? I think it was back in 2017 when my wife and I were 23 years old. We decided that we wanted to retire early. And so we decided, as part of the financial independence retire early movement, the FIRE movement, we're going to invest a large percentage of our income into the Vanguard Total Stock Market Index Fund. And we were stacking, in the early years, we were saving maybe 40-50% of our income. So we were, we both had side hustles even back then. Certainly, I was selling books at that time. They were scaled down much lower, right? We weren't making as much money, but we were still saving and investing 30, 40, 50% of our income and essentially just putting it all in this. And we were putting them in tax incentivized retirement accounts. So we started with the Roth IRA. Again, we both had a 9-to-5 job as teachers. So we also would invest in our 457B and our 403B, which is essentially an equivalent of a 401k. The 457, 403B, those are for public sector employees, whereas the 401k is for private sector employees. They're essentially the same thing. They just have slightly different names to them. Yeah. All right. Yeah. So basically over the last 7 years, my wife and I have just heavily invested in the Vanguard Total Stock Market Index Fund. And when we started investing in 2017, to buy a share was only like $59, $60. And yeah, you can see that as I move my cursor over time, you can see that the value of ownership, or the value to buy a share, has changed, and it's gone up and it's gone down, but overall it's at all-time highs. And so now for every share that we bought over here for $60, it's now worth 144. So it's worth over double, like, 2.2, 2.3 times what we paid for. And so one of the ways to get wealthy is over a long period of time, always putting money away and investing it into the total US stock market, because what you're doing is becoming an owner of profitable businesses. And so if you become an owner of profitable businesses, they continue to make profit and pay you dividends. But then also the value of those companies over time goes up. And so when people in the future want to buy in and buy a chunk of the US economy, they're going to be buying it from people who decide to sell it, which is going to be you. So, currently I'm not selling any shares. And actually, I think that's going to change here pretty shortly, because right now, my wife and I, we just purchased a home. We purchased it on a 30-year mortgage. We put down 20%, but we have enough to just pay off the house in our taxable accounts. I'm thinking we're probably just going to sell pretty much everything in our taxable accounts and just pay off the house, so that we have a house free and clear. And then we can just, from there, continue to invest and build up our accounts again. So, but at this point, I haven't sold anything. Like, since 2017, all of the investing done in, our retirement accounts and our taxable accounts, all of that has just been growing and appreciating in value. And this concept is hard for people to grasp. It was very hard for my students to grasp as well, in terms of like, how do you make money investing? And so I'm going to break that down for you, how we make money investing. And the easiest way I can do it is with a pair of shoes. So Nike, let's see, let's go with Jordans. Jordan, newest release. A lot of people know that shoes are very, very popular and people love collecting shoes. So let's pretend, I don't know, this shoe looks kind of weird. So does that one. I don't know. Let's try to find a cool one. I don't know. All right, let's look at this one. So let's say the Air Jordan 1 Mid SE. By the way, I'm not really into shoes. I don't really care about shoes, but a lot of people do. So let's say this represents what we're buying. Let's say this is like a share of VTSAX, and let's say the price is $135. So if you buy these pairs of shoes for $135, you've actively spent your money to gain ownership of something. So when you buy VTSAX, you're buying ownership of those companies, and you've traded your hard-earned dollars, $135 for it. Now, when this gets shipped to you and it comes in a box, you now own it. Just like when you buy VTSAX, you now own it. You're in possession of it, and you will own it forever until you decide that you don't want to own it, and then you sell it. So what you would do is, like, you get this box of Nike Air Jordans, and you put them on the shelf back there, and they sit on the shelf, and day by day goes by, and what will happen is the value of these shoes will go up and down with the market. So, let's say a week from when you bought them, let's say they go out of stock. Let's just say, for an example, these are sought after shoes. They go out of stock, right? And so you can't buy it directly here on the website for $135 anymore. Well, let's say they go out of stock, and let's say there's a lot of demand for it, and now 1 week later, people are willing to pay $150 for it. Well, technically, your item, your shoes, have appreciated in value. You paid $135 for it, but they're worth $150. But the thing that you have to understand is that just because something appreciates in value doesn't actually mean that you've made any money. It just means that what you own has gone up in value, And you will make money if you realize the gain, which means that you have a gain on paper, but you haven't realized it until you actually sell the thing and get money for it. So if I decide, okay, I'm going to sell it to somebody for 150, I've realized my gain and now I've made a profit of $15. But the thing is, when it comes to investing, the goal is to buy and hold for a long period of time. So essentially it'd be like saying, well, every time you buy a share of VTSAX, it's like you're buying a pair of these shoes and you're stacking them on the shelf and you're just stacking more and more and more and more on your shelf, because what you fundamentally believe is that in the long term, the value of those shoes will be worth well more than 135 to whoever wants to buy it in the future. So how do you make money with investing? Well, at a later date in time, you decide to sell the item and you realize your gains or losses depending on when you're selling it. So again, what I have is, and my wife have, is many, many thousands, hundreds of thousands of dollars in gains that are unrealized, which just simply means that what it's worth now versus what we bought it for, is different. It's worth hundreds of thousands or more, but we haven't made any money until we actually decide to sell it. Now, this is also an incredibly important principle, because when the value of what you own goes down, you must understand that you don't lose any money unless you realize the loss. And so it's equally important to understand that, like during COVID, right before COVID happened, a value of VTSAX, if you bought it, was $83. And so people were actively deciding to buy shares of VTSAX for $83. But what happened was the market, it crashed. It went from 83, had like a 20% decline all the way down to, I don't know what the lowest point was, like $61. Essentially, in a very short period of time, if you were paying 83, now all of a sudden it was worth 61. And that scares a lot of people, because they're like, I just took $83 of my hard-earned money, bought VTSAX, and now 3 months later is worth $61. Yeah, that's what happened. But the thing you have to realize is that it's just the value of what they owned went down. Where people lose money is when they decide to actually sell it and they realize the loss. And so a lot of people freak out. And again, that's what this book will teach you, is that investing is a roller coaster ride. It's incredibly emotional. But you have to understand that when the stock market crashes, which it will inevitably, and by the way, it will continue to crash in the future. There'll be multiple crashes, and there'll be wars in the future. There'll probably be other things like coronavirus. There'll be other points in times where there's corrections and where the value of what you own goes down. But you have to understand that you're in it for the long haul. You're not in it to flip books. Like, it's not like book flipping, where it's like you try to buy a book and flip it in 3 months and make profit. That's not what you're doing. You're trying to buy something and hold it for like 30 or 40 years and let the value of it slowly go up and up over time, so that later on you have a large sum, a large chunk of money. If that makes sense. So what am I trying to get at here? When the market goes down, like as it did in COVID, what you actually should be doing, and what I was doing, is I actually just try to buy more, because remember that nothing has changed about those companies that you bought. Just like if you buy these Nike shoes for $135 and if you put them on your shelf, but then let's say a week goes by and now nobody wants it and now people are only willing to pay $80, nothing has changed with those shoes. They're still the same shoes. The only difference is the perceived value of what people are willing to pay for it. And so what I was doing was going, whoa, what the heck? So these were $135, and now 3 months later, they're $90. Oh, I'm just going to buy more. It's the same thing. I'm getting a discount for it. It's like going to the grocery store, and now eggs, instead of being $3.99, they're $2.99. Well, I'm just going to buy more eggs because that's a deal. That's a discount. But again, my mentality is long-term. And so for me, what I fundamentally believed is that even though the market was sliding and the value of what I was owning was going down, even though I was losing many tens and tens of thousands of dollars, hundreds of thousands of dollars, what I fundamentally believed was that it was short-lived, and that over a longer period of time, it would not only recover, but reach a new high. And the reason why I think that it will always reach new highs is because today we're at a new high. And if you go back, well over 100 years, back to the Great Depression, you go through World War One. Well, I guess it'd be World War One first, then the Great Depression, then World War II, then all the Vietnam War, all these other wars that we've had. You go through, I think, what is it called? Black Monday or Black Friday, I forget what it's called, but 1987 there was a large market crash. You go to the 2001 .com bubble. You go to September 11th. You go to the 2008 housing market crash, which was this dip right here. Then you go to coronavirus. I mean, it doesn't, through all of that hardship, we're still all-time highs. And so what that has taught me, and that's what the book will teach you, is that you should see every dip in the market as I should be careful. I'm not saying you should time the market and hold all your money on the sideline and wait for it to crash. That's not what I'm saying. You should just be investing regularly out of your paycheck every single week or 2 weeks. But at times when the sky is falling and you hear all over the news that stocks are going to zero, that get out now, it's all just noise. It doesn't mean anything. And how I know it doesn't mean anything is because we're at an all-time high today. If it meant something, then we wouldn't be at an all-time high today. But every single crash has not only recovered, but it has then gone to new highs. So going back to all these shares that I bought in 2017 for $68, $69 or like $61, $65, guess what? 3 years later, I was able to buy in at a similar price. So it was like I was able to go back in time and buy shares with money that I had from the future and buy the same thing. It was great. And so a lot of the money that I make and my wife make is off of tumultuous times where people are selling and we're actively buying. Anyways, I don't even know where this video is going. And I don't even know how many people are going to watch this video. So if you're still somebody who's here and you're finding value out of this, then just in the comments section, just so I know who's still here, just put VTSAX. That's the ticker symbol. VTSAX, Vanguard Total Stock Market Index Fund. Put that in the comment section. That's how I know that you're still here, like over 40 minutes in. But I don't know if I'm just wasting my time here. Because I may. I don't know if anyone wants to hear this, but I'll probably wrap it up here soon. But maybe I'll just wrap it up with a couple of final comments, and I'll make more videos like this if you all like it. And if you don't like it, then yeah, there's no reason for me to make it. But this is what I do with my Amazon profits: is that I don't reinvest everything I make back into Amazon because of the fact that I want to control my assets. Like, for me, I think of selling on Amazon as a stepping stone to my ultimate goal. My ultimate goal is to stash as much money into as many shares of VTSAX as possible, because then I own the entire U.S. economy and I have complete control over when I get to buy and sell. And I don't have to follow Amazon's arbitrary rules, and I don't have to worry about counterfeit claims. I don't have to worry about any of that because I own what I own. So that's why the reason why I sell books on Amazon is because it's an amazing income generator, which I can then take that money and move it into a less risky asset, in my opinion, something that I have complete ownership and control over. So that's the point that I was trying to make of this video, is that I think it makes sense to diversify into other things. And also what I will say is, if you're somebody who's just starting out and you have literally no money, which, by the way, there was a point in my life where I was very similar, and it wasn't really that long ago. I mean, it was 2016, 2017, right? It was like 8 years ago. I probably wouldn't recommend, if you have limited capital, investing a ton, because you really do at some level, like in the beginning, you probably do need to reinvest as much as you can so that you can get the ball rolling. But like once you've got the ball rolling to a point where you're now starting to generate significant income, that's when I think it makes sense to start investing, because like if you're only making a couple $1,000s a year, it doesn't make sense for you to put those couple $1,000s into VTSAX, because you could easily make more money just flipping books and just kind of turning your money that way. And that's actually, that's the last principle that I'll end the video on, which is that it's actually very difficult to take a large sum of money and buy books. Like, you know, when people ask me, Joji, how much money do I need to get started? I mean, you can get started with as little as you want, but the more money you have, the better. I'd say like a good amount of startup capital is like $20, $30, $40, $50,000 if you can, because you can buy a decent number of books and keep it rolling. But as you make more and more money and have more money to spend, it becomes harder and harder to spend the money. In other words, it's very hard to spend $500,000 on books, or it's at least much, much more difficult to spend $500,000 on books than it is to spend $200,000 on books, or $50,000 on books, or $20,000 on books. So over time, as you start making more money, you're actually putting it into something that's more passive and something that is working for you at all hours of the day and returning 8%, which is what VTSAX has returned on average after inflation. And the point I'm trying to make here is like 8% of a dollar is 8 cents. So if you invest, $1,000, it's like you're only making 8% of that, which is $80 a year. It's like, oh wow, Joey, $80. Wow, $80 a year, Joji. But again, 8% of a larger number is more significant. So 8% of a dollar is 8 cents. That's not life changing. 8% of $1,000 is $80, not life changing. 8% of $10,000 is $800. Okay, that's sizable. $800. It's like a monthly car payment these days, which is just kind of crazy. But 8% of $100,000 is $8,000. That's actually pretty significant. So when you get $100,000 invested, then 8% of that a year is $8,000. But when you have $1 million invested, 8% of that's $80,000. That's more than the average annual household income in our country. So at this point in time, my wife and I are making more money than the average annual household income in this country doing nothing, just because of the fact that we own something that appreciates in value on average 8% per year after inflation. Now, we'll get there. One day we'll get there, and it'll probably be sooner than you think. 8% of $10 million is $800,000. We just made $800,000 this year? Doing what? Nothing. Oh, we just own VTSA. We just own the US. We were just a shareholder of the wealthiest country in the history of the world. 8%. So that's what I mean is that in the beginning, by the way, I don't have $10 million, but we will have $10 million at one point. I do believe that. Before we're 40? No, I don't think before we're 40. Probably before we're 50 though. Maybe 45. I don't know. We'll see. But in the beginning, what I'd recommend is that if you don't have very much money, it's just flip, hustle. Once you actually start seeing some traction, you start making some money, then start investing, because you'll be able to, build wealth over time. So anyways, this is a really long video. It's 12:33 a.m. in the morning. If you found this video helpful, again, put VTSAX in the comment section below. Leave something else if you want. If you didn't find it helpful, also let me know so I don't need to make a video like this, because it's almost an hour of time. So I appreciate anyone who did watch this video, and I'll see you all in the next one. Peace.